Hi, everyone. Jim Kruzan here. And I just thought I'd give everybody a little message. I've updated some slides that I've been using in client reviews. And since we do a dozen or more reviews a week, I thought it was important to get this out to everyone. For many of us, we've been really patient, kind of waiting for the recession that has still been our base case. And obviously, there is no recession yet. And on top of that, the market seems to be hitting all-time highs. This is not unusual. This is almost the exact same thing that played out back in '01 and also '08 before those recessions as well. The reason we're as cautious as we are is many of our clients are retired, pulling money off their retirement assets, and a huge drop, a 30, 40, 50% drop that often accompanies a recession would really dig a very large hole. It's better to miss some opportunity than to ride down the market to the extent that markets typically correct during a recession. So data has always been very important to us. And frankly, the data, in spite of a lot of rhetoric and celebration that the market's hitting new highs, isn't really getting any better. The problem is the data and the effects of slowdown on the economy have long and variable legs. And we've been talking about this for well over a year. In fact, almost a year and a half. And as a result, a lot of people are throwing the towel in. A lot of people are now just eager to get back in, fear of missing out or whatnot. And that's exactly what happens just before things really hit the fan. A recession doesn't occur like an airplane landing on a runway, nice and smooth. Data continues to deteriorate, and then the floor drops out. The data gets really bad really fast. And it's only then that people panic and worry about earnings and the effect of unemployment and all of that. And then everybody heads for the exits at the same time. And that's why with many recessions, they start abruptly, and 2 or 3 months in, markets are down 30, 40, 50%. So we want to avoid that. So we're very data dependent. So let me just share with you a couple of slides as to what we're looking at today. As of this recording, today is Friday. And just a half an hour ago, the leading economic index was revealed for the month of April. And no surprise to us, it was down again and down pretty severely. It dropped 0.6%, another negative month over month comparison. And the expectation was 0.3, a negative 0.3. So things are deteriorating a little bit faster than expected, which is also something that you'd expect in a recession. So when we spoke last at the quarterly commentary, I mentioned, as I have several times, that there are three outcomes here. Recession, which would imply the data continues to weaken until we see the drop, or a soft landing, which absolutely the market is considering. And that would imply that the data shows improvement. It bottoms out and then improves. Think of it as a Nike swoosh. The other thing we're looking at is a possibility is the market broadens out. Right now, and for many months and most of last year, it was really a one-trick pony. It was the Magnificent Seven, and as it went, so went the market. And not surprisingly, the first several months of this year, it was more of the same. Been there, done that, know exactly what that feels like. The same thing happened in the late 90s, early 2000s. It wasn't AI, but rather .com. And companies eager to get involved, place orders. They oftentimes place 2 or 3 times the orders to ensure that they have the supplies they need. In that case, routers, servers, in this case, chips. The economy slows, people pull back, and these companies realize that they've just placed the next 5 years worth of orders. Things dry up, stocks abruptly drop. So we need the market to broaden out where other areas will participate. Quite honestly, we're beginning to see a little bit of that, but just over the last 2 weeks. Prior to that, it's really been quite narrow. So we'll talk a little bit about that as well. The LEI continues to drop. This is not reflective of today's data, but it was from last month. The last 24 months, 23 of the 24 saw weaker LEI numbers than the month before. It is now the second largest drop recorded. The only one higher or deeper would have been the '08 recession. And as typically the case, as you'll see here in '08, the LEI peaks, it drops, in this case, dropped for almost 2 full years, not even like this, before a recession was actually certified, before the bottom dropped out. There's also a very tight correlation between big drops and recessions, which are identified by those vertical gray bars. Now, the market is expecting a soft landing, and the government has been able to pull one of those off. That was 1997. And that's identified here in the chart as well. And if we look at, as an example, the drop in the LEI in 1997 compared to what we have today, which continues to drop, continues to weaken, it's hard to square the two as, oh yeah, this is very similar to the past. There are many differences, which makes this environment we're in today much more difficult. The biggest thing is we have inflation to deal with, and inflation is not quite going away. The numbers were a little bit better this month by 0.1%, but still significantly high and much higher than the 2% target. In '97, we didn't have inflation, so the Fed could cut rates very quickly, and they could avert an economic slowdown. Here, rates have remained high now for well over 2 years. And the longer that happens, the harder it impacts the economy typically. The other issue is consumers are a bit different. And what I mean by that is back in '97, everybody was used to paying interest, 5 to 6, 7% in many cases on purchases, cars and otherwise. And up until recently, up until 2 years ago, for the past 13 years, interest rates were zero. Government had a ZIRP policy, zero interest rate policy. And as a result, you didn't pay for the money you borrowed. Buy a car, 0%. Furniture, 0%. Appliances, more of the same. So consumers could juggle a whole lot more debt because the payments were a whole lot less with 0%. Now, as those loans term out, as new purchases are created, payments are a lot larger. And as a result, that creates stress with the consumer. And that certainly is a problem and is beginning to show its impact on the economy. Another thing, which is somewhat a telltale sign of upcoming slowdown or hard landing, is this inverted yield curve, which remains inverted. It usually inverts when there's some financial stress. The blue line, as you can see, is the current yield curve. The one immediately beneath that is from a year ago, also inverted. In fact, we've been inverted now since the fall of 2022. And then the one beneath that is from 2 years ago, and that's a healthy yield curve. Short-term rates are lower than long-term rates, as you would expect. When it's inverted, it makes it very difficult for banks to lend. Profit margins erode. So as a result, they increase their standards, and there's less people who qualify for lending. Lending is the lifeblood of the economy. And when that slows up, it has an effect. It's also a lag. And that lag is typically 16 months. It's been a little bit over 16 months now for a variety of reasons. That's a problem. As an example, banks today can borrow from the Fed at, call it 5.4%. And they can lend to you in a mortgage for 30 years That's something closer to 7. That spread is really tiny by bank standards. Doesn't cover operational cost, certainly doesn't cover a profit margin, to say nothing of a reserve for the fact that not everybody's going to pay them back. So they make it more difficult. And that effectively slows the economy down as well. This slide, a little wonky, a little difficult. The blue line measures the spread between a 10-year interest rate and a 1-year. In a healthy economic environment where interest rates are higher, longer term, shorter, or lower, shorter term, the spread between the 10-year and the 1-year would be a positive number. And when it's inverted, it would be a negative number. So the big red line across the page is 0, and anything above 0 is a positive yield curve. Consider that normal. And you'll see almost all the time we have a normal yield curve. But on rare instance, that blue line is below red, and that indicates an inverted yield curve. And you'll also notice in every single case that inverted yield curve precedes a recession. No exception here. And this goes all the way back to the 1960s. And it's not so much when the yield curve inverts and when it starts to revert and normalize is where we see the problems. And I'll just remind you that the yield curve today is flatter than it was simply a year ago. It's beginning to normalize a bit. So it's something to watch, and certainly is at the very best cautionary flag. Another cautionary flag is employment. And it's not so much the employment rate as it is not predictive of anything. It's a lagging indicator, not a leading. But it's the rate of change. How quickly the employment rate is changing is. And there was a economist with the Fed, Claudia Sahm, who developed the Sahm rule, used it to predict slowdowns or recessions forward-looking, and also back-tested as well. And it's highly correlated to recessions. The rule's simple. You take the last 3 unemployment rates. Those are usually released monthly. You average those out, and you compare that to the lowest unemployment rate reported out the last year, within the last 12 months. And if that spread gets to 0.5% or more, we're right on the cusp of a recession. And you can see that blue line, which represents that spread, and you'll see it hovers near 0, which is the horizon. But it gets up to about 0.5%, and it's almost always right on the outward fringe of the beginning of a recession, more or less. And that's important because if you look at the chart to the far right, where we are today, we're pretty close to that 0.5% number. And you'll see that little V, which is really interesting. Last 3 months, the unemployment rate was 3.9, 3.8, 3.9. That's the V. And the low over the last year was about 3.4, nearly a 0.5-point spread. So while all these macros are certainly suggesting, hey, caution, now we're beginning to see other economic data that's showing things to be slowing down. And they tend to slow down and then abruptly fall, which is typically the case. Again, long variable lags. We haven't seen a lot of this in the last year or so. We are now almost over 2 years into the rate hikes, 18, 19 months or more into the inverted yield curve. We're now beginning to see this. GDP fell much more than expected. The unemployment rate increased. New jobs created was 175,000 versus the estimate of 240 versus what it was the previous month, which was 300 and some thousand. And the vast majority of those were actually part-time, which is also problematic. CPI, this is from 2 weeks ago, was 3.5. There was a 0.4% uptick. There was a 0.1% decrease this time around. Super CPI was also up. Both manufacturing PMI and service PMI are now in contraction, weakness, slowdown. And that's important because that's the first time service has been in contraction for well over a year. And all of last year, the thought was the economy is great because the consumers are spending. FOMO spending, the fact that they were locked up with COVID, YOLO spending as well. Now we're beginning to see signs that consumers are backing off. And we're seeing it in default rates as well. Credit card defaults, 3.5% of total account defaults, highest since 2012. That was from 2 weeks ago. This week was also pretty robust in terms of economic data. Credit card delinquencies, 90 days or more, have increased. And now they're the highest since the second quarter of 2011. Auto delinquencies are just under 3% of total loans. And this is the highest since 2010. And PPI, the Producer's Price Index, surprisingly rose a full 0.5% compared to the expectation of an increase of 0.3. The month before, it was actually down. So a huge reversal there. And if you think about it, that's the wholesale inflation rate, which then gets pushed on to the consumer inflation rate. So it'll be interesting to see what that does in the future. CPI, as I said, rose 3.4%, but it was in line with expectation. And it was a little bit better than expected. And as a result, the market took off. Actually, it was a little bit better than the CPI number the month before, but it was right in line with expectation. But because it fell, the market took off. And I think at this point, everybody's looking at the wrong thing. They're looking at the reduction in inflation as the idea that the Fed's going to just start cutting rates and we're off to the races. What they should be looking at is, why is inflation really coming down? And it may very well be because of all these restrictions, because the economy is slowing down. So be careful what you wish for. Consumer confidence or home builder confidence also fell. The Empire State Manufacturing Survey was expected to be ugly at minus 10%, or no, minus 10. It actually came out at minus 15, a significant miss there. And retail sales were expected to be up 0.4%, which is nearly a 5% per annum growth rate. It came out flat for the month. And it was expected at 0.4% to be down a little bit from the month before, not flat. So these are certainly problems that we're having. Now, all the while that's happening, the market continues to go up, and that is typically the case too until it hits the wall. This is for the first 4 months of the year. Has not included the last week or two in May. We'll update that shortly. But at that time, and this is indicative of the problems we have, the S&P was up over 5% for the first 4 months of the year. The Dow Jones Industrial Average was barely up at all. The Russell 2000, which is small cap, which is far more indicative of economic health, was actually down on the year. The aggregate bond index was down nearly 5%. Long-term treasuries were down nearly 10%. And a 60-40 balanced account was up 1%. And the IRA was up commensurate with that. Now, why was the S&P, which gets all the headlines, up as much? And everything else was flat to down. Remember the return, S&P up 5.8. The big reason is the Magnificent Seven. The Magnificent Seven: Microsoft, Apple, Google, Amazon, NVIDIA, Meta, Tesla. The first column shows the returns through the first 4 months of the year. The second column shows the weighting of those companies to the S&P. So as an example, Microsoft is nearly 7% of the S&P. Apple, nearly 6%. So the return times the weighting, and then you add all that up, you realize that those 7 represented 5.58% of the 5.8% return that the S&P had, or 96.04% of the return on the S&P came from those 7. That's exactly why the rest of the market is floundering and the S&P is up. Live by the sword, kind of die by the sword at some point. So this is somewhat problematic and indicative of not a particularly healthy market but somewhat of a confusing market. So I really just wanted to share this with you. I apologize for clients who I've seen here recently because we've updated these slides and we're showing those as part of our review. If anything, it gives you another crack at taking a look at it. But I thought it was important information to push out to everyone else as well, just in terms of where we are. Again, three things can happen. Recession, which would indicate a continuation of weakness in data until the recession hits. The longer we go without it, the harder it typically is. The longer the inverted yield curve remains that way, the harder it typically is on average, historically. Or we can get the soft landing, in which case the data should look better. We're not quite seeing that yet, but we're looking for it daily. Or we get this broadening out, where some of these other areas that have lagged way behind start to show some interest. And then the question is, why is it broadening out? Is it because the market is anticipating better days ahead? It's kind of looking over this horizon, and a rising tide lifts all ships? Or is it clearly a last stage effort where all those investors who finally threw their towel in, tired of waiting, scrambling to get back in the market, but don't want to buy the Magnificent Seven, they start bidding up some of this other stuff just before the next shoe drops? I'm not quite sure, but we're here to help. We're here to try to protect as much as we can and navigate through this. And I understand the math of big losses in retirement. I know what that looks like, and we're trying to avoid that at all costs. So there you have it. Just a quick update. Those who have seen me recently or talked to me recently, this is nothing new. In fact, this coincides with much of the dialogue and discussion we've had over the last year or so. Again, we're following the data. And at some point, the data kind of wins out. So there you have it. If I can be of any service, if there are any questions on anything, please reach out by website or by telephone. Talk to you soon. Have a great summer. Take care.